welcome to TheoTrade. This is Don Kaufman. It's November 14th, 2020, and you are watching the TheoTrade Weekend Update. Well, in this weekend's update, we're going to talk about some of the rotations, some of the risk, and really what I'll call reality completely lost inside of this marketplace in a lot of different respects. So we're going to look at a couple of opportunities, and one of the big ones in this weekend's update that I'm going to spend, quite some time here momentarily discussing has to do a lot to do with really what we term volatility compression. And that's what I'm going to look at as being most advantageous in just the days and of course weeks to come. We're going to have some holiday trade coming up within 2 weeks. Of course, the Thanksgiving holiday. We're not too far off from December timeframe. We have virus numbers that are absolutely exploding. We have that vaccine right on the horizon over here. But with all of that, again, the volatility in the overall marketplace has compressed at the exact same time. And that's the implied volatility I'm discussing. That's how options kind of look at the future of risk. At the exact same time, we're still seeing just wild price movement inside of the underlying themselves. That is the actual implied volatility, or is known as historic implied volatility. So if you look at that, actual price movement in the marketplace is flying all over the place right now. But at the exact same time, the implied volatility, again, has kind of compressed. And it's giving us a really great opportunity in the near term to be a net buyer of implied volatility, which again, I'm going to discuss in a lot more extent here momentarily. At the exact same time as I'm discussing that, listen, everybody saw the rotations. You know, we don't have to go too in depth about some of the rotations that occurred inside of the marketplace here. But again, there is some, what I would term reality lost in here. You're not going to have to look too far, look towards something like the Russell, which is hitting all-time highs. We're going to look at some individual products like Caterpillar here momentarily, which again, all-time highs in an environment that is, well, of course, less than certain. With that, let's get down to business. Let's actually look at a couple of charts and a few trade opportunities. All right, let's get started with a couple of charts and a few trade ideas. We'll start here inside of the SPX just to show the overall market movement according, of course, to expected move, because we're going to discuss here momentarily what I term a little bit of volatility compression. And in fact, we'll explain that as I'm actually looking at the SPX. So over the last couple of weeks inside of the SPX, it has just been downright unruly, right? So we've been breaching expected moves, ripping through the expected move in the downside, ripping through the expected move in the upside. Obviously, in this past week of trade, Monday was just downright wild as we exploded all the way to 36.45 and change, and you have to almost hesitate to see how far up we actually went on Monday before reverting back down. But net, one of the points that I want to make over here when I start talking about, you know, volatility compression and so forth has to do with the fact that the actual price movement in the marketplace, as I said a moment ago, has just been out, you know, downright unruly. I mean, we're just ripping apart what we're anticipating to move. And for those of you that are a little bit newer to this and are not necessarily familiar with some of that phrasing there, you know, in terms of expected move, what I'm referencing here in the SPX, and I'm going to go ahead and go out to this next Friday's expiration. So when I go out to Friday expiration, one of the things that really kind of resonates with me on a week-to-week basis, take a look right over here. Okay, that's your expected move. So it says we're supposed to move about $82. Now that's $82 higher, $82 lower. And, you know, one of the questions I get just incessantly is, you know, somebody says, all right, so you're supposed to move $82. What did we actually move? And if the answer is, well, we moved much more than 82, well, there's edge in there and there's trade opportunities in there. And that's one of the things that, you know, as a trader, you got to latch onto, and you got to recognize, like, you know, some people just go into the marketplace and they just blindly start talking about, I'm going to sell premium, I'm going to sell premium, I'm going to sell premium till I'm blue in the face. But the problem with that notion is, okay, do you want to sell options premium in an environment that is, well, breaching through the options premium? And, you know, when I talk about, like, you know, $82, it just doesn't, you know, the expected move, it doesn't really like resonate with a lot of people. But what it kind of means is the average, okay, of all the options in this, you know, chain for November 20th, they average out to about $82. So if you were to go out and you were to be a premium seller, okay, you're selling premium, all right, even if you sold like the at the money straddle for less than, okay, about $82. And that's not going to give you edge. It's the exact opposite. If you sold premium right now and you said, well, we're supposed to move $82, but in previous weeks we've smoked that move, and in previous weeks we smoked that move and smoked it again. You have to recognize what's going on here. And what is going on here is that the options marketplace, right there, that 82 bucks, it's not doing a great job of handicapping risk. It's just not. I mean, when it says it's supposed to move 82 bucks and all of a sudden we move, $103, or in the case like this past week, and again, I hate to use, past examples. I always want to talk about in the present and what I see as terms of advantageous moving forward. But if you looked at the previous week over here, this was a huge move that was priced in, like $160 move was priced in, and we still ripped through it. And this past week of trade, we were expecting, and again, this is something that every single weekend video I will bring this up. Like this past week, we were expecting a $91 move. Now, at the end of the week, yeah, we finished inside of that $90 move, but was by what? A hair. But earlier in the week, we absolutely blew through it. So we were looking for this, $91 move up, $91 move down. And now, okay, in this next week of trade, as I was saying, there's been volatility compression. Okay, and that volatility is compressing down now to what? About an $82 move higher or an $82 move lower? You got to be kidding me. We've been just smashing through it. And again, that's what I'm telling you is advantageous right now. Okay, all directional bias aside, and please, okay, check your directional bias at the door right now. I'll have some directionally biased trades and some ideas for you in a few moments over here. But check your bias at the door. The only thing I'm saying here is you can actually buy premium on both sides of this market, literally buying things like iron condors. And as long as we keep smashing through expected moves, again, we're expected to move $82, but we move, for instance, 100. As long as we keep smashing expected moves, okay, you got some P&L in there. And listen, I'm displaying this in the SPX, but quite frankly, where are some of the most advantageous areas? Take a look at the IWM. All right, so we'll scroll back up over here, and again, we're talking a little bit about volatility compression. We'll come down to the monsters of tech, but we actually cruise over to the IWM, the Russell. Okay, this is the Russell ETF, and we talk about volatility compression. Again, look at the moves that the Russell's making, smashing expected moves, week in and week out, people. This is one of the largest breaches in recent history. I mean, this is in effect, a crash to the upside in the Russell. Okay, and again, we're going to talk about the Russell here momentarily once again because it's at all-time highs, and I think it's opportunistic, okay, for one of the trades that I'm discussing here. So this is, again, what volatility compression is about. There's explosive moves on lower implied volatility. And another way to kind of denote this, other than looking at like expected moves and we're smashing through the expected moves, I can actually pull up, okay, an implied vol range. Really what this is implied volatility percentile, better known as an implied volatility rank. And you can see, okay, look how low the implied volatility is right now, yet we're moving huge. So if you went out there and you started comparing things like, and I hate to do this kind of study, but you can go compare like, historical volatility to implied volatility, which I don't think is very effective. The only point that I'm trying to make is in terms of implied volatility ranking, we're down there right now. I mean, we're down quite considerably, but still seeing huge movement. We're going to look at Caterpillar in a moment, and we're going to see it in Caterpillar. Okay, there's other trades I've got on, and things like Microsoft. Look, this is some of the lowest, this lowest IV rank that we've seen since the onset of the Corona crash. And yet, even stocks like Microsoft, they're not just moving, they're moving absolutely huge. So that's what I'm referencing in terms of volatility compression. And I think it's one of the most advantageous areas of the marketplace right smack in front of us. And of course, somebody will say, well, the market can stop moving. The holidays are coming. But it, again, sitting near all-time highs, typically we wouldn't see that kind of price action, which again, let's discuss it. So as I was saying, rotations, risk, and reality loss. And you'll understand the reality lost here momentarily. So volatility compression first and foremost. The next we want to go onto the docket over here is the monsters of tech. Okay, is it the buying opportunity? Buying opportunity of the decade or the beginning of the end? When we take a look at the monsters of tech, and for those of you that do not know what the monsters of tech are, that is a kind of a conglomerate symbol that we built. All right, and it's Apple, it's Amazon, it's Facebook, it's Google, it's Microsoft, and they're all compiled together into one kind of ratio. And I think it's a great way to look at, again, what's my own index. I've turned it the monsters of tech, and it works for me. So the monsters of tech, okay, have kind of consolidated a little bit this week after some sell side activity. But another way to denote this is if you look at the QQQ, and look at its expected move. Here is something, again, very, very much contrasting views of the marketplace. So you have the Nasdaq, which is sitting towards the lower edge of the expected move on the week, right? So this is when we're talking about the rotations a little bit. So again, the Nasdaq sitting towards the lower edge of the expected move. The spiders, okay, or what we looked at in the SPX a moment ago, the SPX, of course, sitting at the upper edge of the expected move. And then last but definitely not least, you got to pull the Russell back up in here, look at its expected move, and it smashes through the upside. So this just wicked rotation, okay, kind of plays out in very, very short order. But it leaves us, okay, kind of looking again specifically at some of the monsters of tech. And again, I'll bring up something like Microsoft. Microsoft, hey, listen, net, what has it done, okay, for the umpteen months in a row? Because everybody's still fascinated in talking about technology stocks, and the answer is here in Microsoft, absolutely nothing since June. Okay, literally, absolutely nothing. We bring up Apple. It's the exact same story. Apple's really been range bound since roughly August. Okay, cruise into Facebook. Same animal, pretty much since August, has done absolutely nothing over here. I want to take a look at Amazon. Amazon since July. Okay, Google is one of the few that has actually had upside momentum and is sitting at or near all-time highs. Again, could be advantageous in the very near term. Why am I looking at Google? Okay, because it too, its implied volatility is crushed down. So the implied volatility is crushed down, and yet this thing is propagating ridiculous movement in the marketplace. Granted, a lot of this is vaulted off of earnings. It exploded to the upside off of earnings. But here's a stock that, again, it could absolutely break out or break down. And at the same time, you're able to buy the volatility in there dirt cheap. And again, that's not me denoting you want to get bullish or bearish. The answer is yes, sure, both. Okay, this is buy side kind of iron condors that I'm looking at, or we term gamma iron condors. So the monsters of tech right now, okay, when I ask if it's the beginning, the buying opportunity of the beginning of the end, okay, I'm being a little facetious with that one. I have absolutely no intention of taking any substantial directional bias per se in individual, products. I do absolutely unequivocally have some positions, okay, in a number of the monsters of tech. I do actually have some short positions in there. However, okay, I am not, okay, adding to any of those positions. I'm not here to tell you like this is the greatest time to short Microsoft. No, at this point in time, okay, again, rather than being long or short, I see it as a buying opportunity of implied volatility. And I just want to make that clear. Again, I'm carrying some short positions, but at the exact same time, like right here, this to me is neither a buying opportunity nor an opportunity to short, at least where it's currently trading at. The same thing is true, of course, of Apple. We've hit, a little bit of a situation. I mean, we're right at the head. Again, we've compressed in volatility, and it looks like we're ready to make a decent sized move there in terms of the monsters of tech. Now, onward and upward. Let's go to the IWM. So the IWM, explosive moves. In fact, it's worth bringing up even a 15-year weekly on this one, explosive moves. Okay, and I want to make something very clear about the IWM. Here's a product where I am long. And again, I always will denote whatever position I happen to have on in a given underlying, right? So I am absolutely long in here. In fact, let's bring up the proper account, okay? I am long inside of the IWM. I have been long in the IWM for a considerable period of time, but at the exact same time, I'm also a net buyer of volatility, okay? So when I say that I'm long, okay, I'm long, but risk reward is just screaming get out now. And that's where I'm actually talking about, rotations, risk. In terms of risk reward, okay, I don't think that I can't make a good argument to myself to sustain this IWM position maybe more than a few more days to see if the rotations are still kind of in play, and that would be it. So I am telling people that that are kind of following me in the IWM, and again, I've been long the IWM for quite some time. Again, if you're kind of curious in here on the IWM position, all right, this position, the inception of it was all the way back on March 11th. So for those of you that are, always saying he carries a lot of bearish positions, really, because on March 11th, which was before we hit the bottom in here, I've actually been long this particular product. So the IWM, again, got into a long position, have carried that long position from roughly, and again, if you want to see the exact entry price in here, it's a whole lot of trades I'm doing in here, but the entry price in this particular case, I paid right around 129, close to 130, and it's marking right now at 173 and change. And I've got this in a couple of different accounts here, but net, I'm up and I'm up big. And I don't like the risk reward at this point, where that is, there's upside potential, absolutely, but the downside is just hideous. And I'm not much into fundamentals, but I'll just make a very, very brief argument. I was talking about this a little bit on TheoTrade yesterday, and the brief argument is this: you just can't give me a fundamental reason, okay, that this product should be at an all-time high. And it's the reemergence, it's the vaccine, it's this, it's that. People, it's the small caps, and they're being bailed out left and right now. And to make an argument for me fundamentally that this thing should be at an all-time high, I just tuned you out right there. It's impossible for me to get through that, and that's one of the reasons. The risk reward, okay, in here, just for me, is just no longer viable. It's, how much more upside potential am I going to look for? I mean, I've run this thing from 130 bucks to 170 bucks, but that's neither here nor there. It's this most recent move. Okay, it's this most recent move. It's this most recent move. I mean, this thing is just violence to the upside. It's like a crash to the upside. And sitting where we're at in the world, and it's really difficult sometimes to look at what reality is, and then you realize, like, wait a second, we're in the middle of a recession, severe recession. People are even talking about a depression. There's bailouts being discussed. Reality is completely lost. So at that, all I have to go on is risk reward. Reality is gone. I got to go on risk reward, and that's why I'm going to bail out of the IWM long positions here, probably fairly soon. And again, just wanted to denote that I'm long, but risk reward says get out now. Onward and upward. This is something I talked about also a considerable amount in some of the updates. Of course, I did on both Monday and Wednesday. We hit the exact price point that we expected to. So if you listened on Monday, if you listened on Wednesday, we said, hey, get ready. It's a foregone conclusion that the XLF will actually probably pull back to 2650. It did just that, pop back to the upside. The only reason I wanted to mention the XLF, okay, I don't necessarily think that we're out of the woods yet there. I think another pullback to 2650 is probably going to be justified throughout the course of this week. Look for it. Onward and upward here. The next thing I want to talk about is the energy sector. Okay, so here's another one where I'm long. Okay, and I'm going to tell you guys, listen, I'm long the energy sector in a ton of different ways. I'm actually long shares. Okay, I'm long shares of the XLE. I'm long shares of the XOP. I've been long energy, and here's another one where I've been long a pretty considerable period of time. And I'm going to tell you right now, I have not broken even in energy. I have not broken even in energy, but I've sold enough options premium against my positions, and you can see I'm actually selling some premium against this. I've been selling premium against XOP, right? And there are also some dividend yields in here, okay? But now, net, after all the premium sold and everything, okay, doesn't even matter that I'm necessarily down on the stock, okay? Here's another position where I'm on kind of short time in terms of wanting to hold this particular position. The explosion to the upside in here is just too far gone. And the energy sector, it's not just about the energy sector. Energy sector isn't really on the road to recovery. Listen, here's another one where fundamentally speaking, you're just not going to convince me. I mean, we're talking about lockdowns in the US again. Okay, I think energy is on thin ice at this point. But that's also true if you look at some of the airline stocks. I mean, this particular trade that I'm talking about in the XLE, the energy sector ETF, okay, should really resonate with you. And anything that popped to the upside, okay, in a ridiculous manner, you're not going to have to look too far if you start looking at some of the airline stocks and so forth. Some of the moves that we've seen Okay, ridiculous. Now, United Airlines has already pulled back and pulled back considerably off some of the vaccine conversation. But again, there's so many different underlyings here that we could probably bring up in regards to the energy sector. Again, I'm not feeling it in terms of risk reward there. All right, next one on the docket here, we're actually going to bring up Caterpillar, because Caterpillar I've got a number of different positions on. First and foremost, let me denote, I am short Caterpillar. I am short. Okay, I am short Caterpillar using deep in the money puts. It's synthetic short stock replacement. So instead of being short the physical stock, I'm actually long deep in the money puts, which gives me a synthetic short stock replacement. But that's not why I'm bringing it up. Things at all-time highs. And again, here's another one where, the last couple of products we've brought up, the IWM, right? I'm like, oh, risk reward looks hideous, right? The XLE, I'm like, the road to recovery. Sorry, you're not gonna get me to buy into that. Caterpillar, same animal. All right, take a look at Caterpillar right now, which is effectively at all-time highs on what is going to be beyond a formidable, economic situation moving forward. I think that's fair to say. And when it comes down to Caterpillar here, I'm not going to tell you to get short. If you want to get short, great. Okay, I think this is a wonderful risk reward opportunity. But the reason I'm actually bringing up Caterpillar is once again, its implied volatility has been crushed down. And because it's been crushed down, I have actually been buying iron condors in here. And I'm not looking for, a huge move, but this has been a fairly volatile product. And forget about even earnings. Okay, the earnings are neither here nor there. Okay, this is a product that was moving prior to the earnings, obviously moved down on the earnings, shot back up, jumped higher. Okay, everything is kind of compressed this last week of trade, but net, this thing is ready to rumble. It's ready to move. So I'm actually buying volatility, but at the same time, I absolutely do. Okay, have and will continue to have some short positions inside of Caterpillar. Those are a couple of trades that I'm going to be doing again. I like the idea, and we're going to be discussing this in some extent this week on TheoTrade of again, some risk reward style positions. We're going to be looking at buying some volatility and, of course, the expected move. And I go back to the expected move. Last week, the expected move in the SPX, right? The expected move in the SPX was a $91 move. Okay, which is, again, $91 move. It's big time, right? We smashed through it early in the week, but we actually did come inside the expected move. And all of a sudden, with this huge move that we've seen this past week, okay, the massive move the week before that, and the week before that was a smash to the downside. Yet they still compress volatility even further. And that's why I think it's advantageous right now to be on the buy side of that. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.